Hey, we're on. Hey, everyone. How you guys doing? As always, Shane and Richard Hodges here, ready to rock and roll on another Thursday. And finally, we've got something to talk about. We actually had something happen yesterday, which has been like 2 months waiting. So that's good. And we've got some really relevant stuff to talk about. So let's just wait for some people to come on board. Let's just make sure everybody can hear us. Can everyone hear me?
I can hear you, Shane. Now we've got some of the old usual suspects and some new names.
Right on. Yeah, let's not call them old.
Oh yeah, yeah. Sorry, usual suspects. Old
I'm
faithfuls.
joking. I'm joking. Old faithfuls. That's what we'll call them. Old faithfuls. Yeah, I was trying to upload a file here, but it hasn't been working, and I've logged in and out. That still hasn't worked, so I'm just going to abandon that for now. No problem. All right, so who we got on? We got Ken from Melbourne. Yep, seem to get a couple Australians on every call. That's great. From Marbella, Luke. Good to see you. I don't know, Luke. I'm assuming you live down in Marbella. When I first moved to Europe, Marbella was actually where I was going to move to. Just because I had friends kicking around there. I'm not sure I would have liked it as much as Andorra, but I don't know. Richard, you've been to Marbella, haven't you?
I don't
No?
think so.
No. All right. All right. I thought, a big swinger like you would have been cruising in there on your yacht and, just
I
living
only
life.
tend to travel where I'm paid to travel to. So.
I got Arnie from Iceland. Excellent. Good. Jandrea, good to see you. All right. So today, let's get started. We've got 30 minutes. 30 minutes exactly. And let me just roll over here. I'm going to go to...
Hey, Jason.
Give me 1 second. All right. And we got...
we should do those tip things, on these like live streaming things where they can tip you money. We should do that.
Wouldn't that be cool? And every time they do, they get a little ching sound, a little dollar sign floats up or something. That'd be so cool.
Yeah.
That'd be really cool. Yeah. Virtual strippers basically would become. Yeah.
I'm not sure anyone's going to tip me for watching me strip. But...
well, stripping our knowledge. All right. So, hey, I do have a poll question here. I'm going to publish it right now. And, maybe it's a day late and a dollar short. But do you think the market's going to break up or down, or a substantial IV expansion or increase by the end of August?
Oh.
End of August. I mean, hey, we're not far away. That's like 13 days away, right? So, I think it's a relevant question. So we'll come back to that in a bit.
I'll give my thoughts on that at the end.
Yeah. Cool. Great.
I always do. No one asks me, but I do it anyway.
We love your thoughts. All right, let me get started here. So today, what are we going to talk about? Well, we're going to talk about debit and ratio spreads, and this is super relevant for some trades that I put on Tuesday, 2 days ago, when I made up these slides. So it's actually really quite interesting to see things played out. Now, obviously, we didn't have a huge move yesterday, but a bit of a move is better than nothing, which has been sort of the case for the last 6 weeks. Then, of course, we're going to take a look at our charts, our trades we got on, a bit of analysis, and then a Q&A at the end, as always. So when we're talking about debit spreads, I'm just talking about a plain old vanilla. Sometimes I do get comments from people saying, Shane, you guys are great. We love you, but I don't understand. I don't understand these diagonals. I don't understand these butterflies or whatever you're talking about. Debit spreads are super straightforward. Anyone can do it. It doesn't matter. You're new. You've been around forever. They always come into play at some point. There's an appropriate use for them. And basically, when we're talking about a call spread, okay, I call it a call debit spread. People call it a bull call spread. Bull call because you're bullish and you're using calls. You're simply buying a lower strike option, call option, and then you're subsequently selling a higher strike call option with the same expiry date. That's it, right? And you're capping your profits with that higher expiry date. It's a directional trade. It's bullish. You're buying a call. You want it to go your direction. You want it to, even blow through your short strike. That's fine. You're going to maximize your profits at that point. And you're going to pay a net premium debit for that trade because you're the closer to the money call that you're buying is going to be more expensive than the one further away that you're selling, right? But what it does is it helps offset that cost. So it's better than just buying the call naked, okay? That's why we're doing it. It's a directional bet. Now, if we're looking on the other side, there's a put debit spread or a bear put spread because you're bearish, you want it to go down. You're selling a higher strike put, or sorry, I meant to put buy there. My bad. I corrected my slides, but I forgot I didn't download the new presentation. So I've got a couple little errors that might be in here. Anyways, you're buying the higher strike put, selling a lower price put, same expiry date. It's a directional trade, and you're going to pay a net premium. Okay. So when we look at the risk reward profile, it's very, very simple. You know, the price of the underlying is usually going to be around here on a bull call spread. You buy a long call, it's going to cost you money, right? But at the same time, you're selling a call at a higher price to offset the cost of doing that, but you're maximizing, you're capping your profit. Okay. I shouldn't say max profit. I should say cap your profit at that short call strike. All right. So if we look at it at a chart, and again, I took these, the screen share or the screenshot on Tuesday afternoon, and we can see the price of Bitcoin here is 29,300-ish, somewhere around there. So if we want to use a bear put spread or a put debit spread, we thought it was going to go down, but we don't think it's going to go down, probably not below 27,000. If it does, it's not a big deal, but we don't think it's probably got that much. But we think it's going to go down. This is what we can do, right? We can come along and we can buy. And let's say we do this short time frame. We're looking at September 1st. That happened. That was a 16 days to expiration. That was 2 days ago. So now it's 14 days to expiration. Okay. We can buy the 28,500 put, and we can sell the 27,000, right? That gives us $1,500 of profit in there if it goes our way before our gains are capped. All right. And we're going to pay a net debit for that. So if we look over here at that time, I went over onto Debit. I took a look. The 28,500 was about a 30 delta. Maybe it was like a 29 delta, something like that. And in Bitcoin, the dollar equivalent of Bitcoin at the time was 0.0125 Bitcoin. That was worth about $368. And the put, which was an 11 delta put that we sold as protection, or to not protection, but to decrease the cost of this trade, would have earned us about $115. Okay, so in total, you know, we're paying $368 for the long put, and we're getting some premium back, $115 for the short put, a total debit of $253 at that time. That's a better deal than just going out there and spending $368. Because if this thing doesn't move in 16 days, guess what? You're out that $368. You're going to be out that $253. So again, it's a directional bet. Now, I'm not saying that buying the 30 delta put was the best option at that time. Maybe you buy the at the money put. I don't know, whatever. Everybody's got a preference depending on where they think it's going to go. But we're been in a pretty flat market. So, this directional bet, this is what it looked like. Now, that leads us into ratio spreads. There's all different ways we can use ratio spreads, but just think about this in the same way I just talked about a standard debit spread, except we're just going to sell more contracts. That's it. Okay. And we're doing this to reduce our cost even further, maybe break even, or why not get paid to put the trade on? It's not always appropriate, depending on the time, but we think it's appropriate right now for us. We're happy to do that. We are, of course, assuming some more risk by doing that, right? Because if we sell at a greater, like a 1-to-2 ratio, or a 1-to-3 ratio, 1-to-4 ratio, those extra ones we sold are naked. And those will need to be managed in the event that the price doesn't go our way. But we're perfectly happy to do that. For God's sakes, we've been doing this for 25 years. It's what we do day in and day out. So we're okay with that. So let's just take a look at ETH. I took this data again from Tuesday. And at the time, the market price was around, 1,840, somewhere around there, $1,840. It was floating around there. And I just took a look and I said, what if I bought the 2,000 calls? Because I felt this thing, let's just say I felt this thing was going to go up at that time. And I wanted to pay, reduce the cost. I could sell the 2,100 calls. So it's a 12 delta and a 5 delta. Now, normally I wouldn't do a debit spread with a 12 delta unless I was really thinking it's going to go. So this is just an example here. I probably would have went with the 1950 or maybe even the 1900 long. But this is just an example. So at the time, it would cost $7.56 to buy those calls, and you would have got $3.51 in premium to reduce the cost. So a 405 debit. Okay, great, wonderful. There's our 16-day to expiration, which was a September 1st expiry. Bull call spread. We think it's going up. We think it could even go as high as 2,100, maybe a little bit past. Not a problem. That's fine. With these debit spreads, most traders actually want it to go past their short strike. They don't want it to go blowing past, but that way they're going to realize the full value. A lot of people say, all right, hey, but Shane, the perfect scenario is if this thing goes up to 2,100 and expires right at 2,100, so you get all premium from the calls and you maximize the short calls and you maximize your long call. Yeah, well, that's not going to happen. There's probably a greater chance of that happening than me spending 2 hours in the holodeck with 7 of 9. It's not going to happen. So, maybe once or twice in your entire trading career will it expire exactly where you want it to the dollar on expiry dates. It's not going to happen. So, most of the time, most traders want to go past that 2,100 because they're going to be maximizing that trade. Okay. So we're talking about ratios. So instead of going here and paying, $4.05, what if I did a 1x4? What if I sold 4 of these 5 delta calls to completely offset and get paid? What's that going to look like? Well, we're going to get paid. We're going to get paid $6.48 at that time, the value in ETH, to put that trade on. I'm okay with that because what's the worst case scenario? Well, if it goes down, I made a bunch of money. If it goes up, anywhere below 2,100, I'm making money. If it blows past 20, let's say it goes to 2,400 on a news play. Well, I've got 3 contracts I have to manage, don't I? Or 3 times 1. So if I bought 10 of these 12 delta calls and sold 40 of the 2,100s, well, I've got 30 calls I have to manage that are naked. I'm okay with that. Been doing this 25 years. We're okay with that. Okay, so that is what the ratio spread and how we do it. Now you can adjust this. I don't want to complicate and muddy the waters here, but we could sell maybe some 2050s, a few 2100s, and some 2150s, right? And make a 1x4 ratio spread, but spread, or like Richard likes to say, smear. So we're going to smear some expiries. I like that idea too. You're not putting everything on at once. Now, I actually did take some of these exact trades I'm going to show you in a second. Now, they didn't work out the way I wanted them to exactly because I didn't get the fills I want because the market moved when I put my orders out, but I still got the trade on, and I was quite happy to do so. So hang on, let me go over here. I got to share my screen now. Why don't I see it? There it is. So you guys see this okay?
I do.
Okay, great. All right. So this is Bitcoin. Again, I still don't have any Bitcoin positions on, but there's that red line we were adhering to. We busted below it. I expected to keep going down. I know we're in a low volume market. It could go right back up and be in the range and fart around. It could easily happen, but I wouldn't be surprised if we started ticking down and then end up sticking kind of in this 26, 27, 25, the extreme. I don't think that'll happen unless there's a news play. But that's interesting. Let's take a look at ETH. Let's take a look at those trades. So if you watched the show last week, you knew I put on these directional trades, right? This call trade up here was actually a calendar ratio. It is now a diagonal. And I said last week that calendar is going to turn into a diagonal as soon as I change the strike prices, okay? I've added more to that position. I've also added more. That was like on the weekend, I added more to this because I was like, I want to get paid because this market's going to move. It's going to move at some point in time. Maybe it won't move by the end of October when these diagonals are on, but it's going to move. So I wanted to put more on. So I've got the October 27, 1900 calls is what I bought. I sold the 1900s, which is a calendar. Now I've gone. Those are the 18th of August weekly. So every week I'm selling the weekly, right? So 18th of August came along. Those are all expired worthlessly. Actually, I actually bought them back dirt cheap. I didn't let them expire. And I sold the 25 August, the next, which is the next weekly expiry. The 1950 calls is a 1x2 and the 1900 calls is a 1x1. Now I wanted to sell more calls against it. And I was on the inside, then the market dropped down and I didn't get the fill and it sucked, but whatever, that's life. I still got paid to put the position on, so I'm okay. So I actually don't, let's say the market keeps going down. I don't even need to take that trade off because I got paid to get into it. I'll have to take a look at the numbers. I didn't make enough to cover the cost of the long calls just yet. But if the market keeps going down, I will take that trade off. Although the end of October is a long time. We could go right down here and bounce right back up for all I know. And then I'll look like I have egg on my face, but it won't be the first time that happened. What's the put diagonal look like? Well, I bought the 1800 puts, the October 27s. I can't remember what the expire was in the weekly of 18 Aug, but I took those out. Now I sold 25 August, 1750 puts, 1 for 1. I'm just doing 1 for 1 on the put side. Put side's more dangerous, right? Because the value of the underlying asset is decreasing. We have the underlying asset in our Debit account. What else did I did? What else did I did? What else did I did? What else did I do? Well, I put on a ratio spread right here, right? This is a September 1st. I bought the 2100s. I sold the 2200s. So for every contract I bought, I sold 2. Okay, sold 2. So it's free for me to get into this trade. Wonderful. It's going the other way. That's fine. We'll also put one on the put side, which is looking pretty lovely right now, I have to say. 1750s I bought, and I sold the 1650s, and I did that as a 1x2 as well. So it didn't. I can't remember if I did this at a net credit or it was just a small debit, but I felt a little bit more inclined that we're going to go down. So that's why I was pretty happy to do that. Now I still got all these long puts all over the bloody place that I was picking up for cheap over the last 2 months as insurance. But that's what I have going on, and that's how I use these ratio spreads. For all I know, this market would have just kept going sideways for another month or two, and it might go right back up and keep going sideways. But you know what? I like to have these directional bets on, especially when they don't cost me anything, cost me very little, or I get paid for it. The only thing is when we put on a ratio spread, we have to be prepared to manage that position because we're going to have some naked exposure and a bit more risk. So I'm not going to put on a ratio spread and then go for a holiday and not check my phone for 2 weeks. I'm not going to do that, right? You got to be around. You want to be able to manage that. Okay, I'm trying to go faster so I have time for questions. Richard, over to you.
Yeah. So actually, I was just looking at my book. We could actually just stick a ratio spread on now if people want to see it happen.
Let's do it.
From last time I was playing around on 1st of September, and those trades have worked out pretty well. I think the last call or the call before, I did a 3,500 call versus the 3 of the 31,500s. Since then, I did some 31,000s against the 32,000s. And now with the move down, I'm just looking at the 29,500 versus 3,500s. So we could pay 130 and receive 195 if we're lucky. Yeah, we could do that. Let's just stick on a 0.2 of those. We're filled and sell. Is it 0.6 of these? Just wait and see if they get filled, and that's actually overwrite some of my other longs, but it doesn't really matter because in the end the book is just a book. All the risk amalgamates. I was thinking about the same on the put side. So what, 27,500 short or long, 114 against the 26,500s. Probably a reasonable range, right? I could even be a bit more aggressive, couldn't I? I could sell like 4, 5 of the 26,000s. So if we went, what did I say, 27,500, 5, I don't know, by 0.2 of those. And what do we say? 26,000. Could sell one of those. Nope, filled. Actually, you notice that that actually hasn't hurt my margin, even though I just sold a 1 Bitcoin notional of short unhedged. It's because actually all the margin system on Debit is assuming that all my risk is on the upside. If you look at my margin thingy here, it's all red on the right-hand side. And that's because I'm heavily short futures because I'm converting my portfolio into synthetic dollars. I measure my P&L on this account in dollars, and that's it. Simple as that. The position's on or getting on. 0.2, yeah. So 1/5 on the puts. That could get quite exciting actually over the next few days. I think that 26,000.
Uh-oh. Hey, Richard, I'm so sorry, but it looks like you got some comments saying they can't see your screen. It's funny, I can see your screen. I'm not sure why. Let me turn the slide deck off. Maybe that's.
Let me try and reshare it.
Oh, you know what? It almost looks like even the slides got turned off for some reason. I think there's something happening with our software. It kicked everything off.
Can everyone see that now or not?
Yeah, please let us know, guys.
No.
Okay.
Oh.
Apollo says you don't. That is so strange. It's got to be a software issue we're having here, guys. So sorry. But you saw mine. Oh, Corey says it's fine now. Okay, great.
It's back. Okay. So I can go back here and hopefully stick my mouse over it, and you can see. I'll just repeat myself quickly. So you can see I've bought 0.2 of the 27,500 puts on the 1st of September, and I've sold against those 5 of the 26,000 puts. And similarly, I've bought 0.2 of the 29,500s, and I'm in the process of offering the 3 of the, or 0.6 of the 30,500. Interestingly, no one's taking me, even though you see that green box. That's telling me that my offer is actually better than the indicative price suggested by Debit. So that green box is telling people that they should be taking my price. So if anyone out there wants to hit that, you make a basis point theoretically. But I'll just leave that run. The markets move around. It'll get hit eventually. So that's my play. First, I think 1st of September is quite a nice play for this, because if you do it too close, so 25th of August is a week away, and you can't quite get the same steepness of smile to get the trades on nicely. But 2 weeks is enough, and the smile is deep enough, and you can kind of get that trade on. And a nice thing about this trade is that it also plays to the smile, because as the market moves, so that the long leg gets in the money, that will lower the implied vol of the long leg, which means it will become relatively cheaper, and you'll lose your money. But you've now got 5 times the short leg, and that's going to be getting cheaper as well, but you're short it, so you start making money at 5 times the rate. So as long as you delta hedge fairly regularly, that trade's pretty safe. That's why I'm not worried about the short leg being naked.
Cool. I was checking the volatility surface this morning. Well, actually, even just before the call, and it looks like, as we expect, a little bit of skew in the short term on the put side. Kind of to be expected. And there wasn't much of an IV expansion on ETH, tiny bit, but a little bit more on Bitcoin, not a lot. Did you have, so you said you wanted to share some thoughts on by the poll, or do you want to talk about that later?
Oh yeah, poll. What's the poll saying? Poll is pretty split, right? 48% yes and 52% no. I actually think there's about a 50% chance of a breakout by September. So I think the poll kind of reflects my view, actually. I'm certainly getting very wary about selling too much risk out in beyond a month. And I think the rest of the market is also feeling the same way, because there's like a 12 vol skew between slope between the 1 week at the monies and 3 months, I think. What's my chart saying here? 1 minute at the money is 28.5, 3 months 36. That's what 8 vols. And then at 6 months we're out at 38, and then at 9 months 41. And got to be honest, 41 vol for 9 months not enough for me to want to sell anything. I don't believe the narrative that the halving is going to cause Bitcoin to go to the moon. But I just think that there'll be volatility by then, for whatever reason. Because people will be thinking it's going to the moon, and other people saying it isn't, and there'll be a big argument about it, and people will get liquidated, and we'll all make money, right?
All right, we only got 5 minutes left, so there's a new feature, top left your corner price ladder. We're not going to talk about that today. We'll talk about that next week, and we have not explored it yet. Richard just pointed out to me literally before the call, and I was like, "What? Whoa!"
Just noticed it, yeah. I saw the email yesterday from Debit or 2 days ago, and then thought, "What the hell's that?" Yeah.
It's going to be perfect for me, I think, because it's exactly how I use futures. Anyways, let's quickly jump into some questions because we only got 5 minutes. Def, I answered your questions. I sent you a message. If you want help with hedging and understanding that, definitely sign up for our 7-day free trial. You can be on our Telegram channel. We post our trades in real time. We chat. That's silver level and above. Of course, the gold level is we do private mentoring.
If you really want to go for it, sign up as a gold member and get free one-to-one time with us whenever you want, all through the year.
Yeah, perfect.
We have some people signing up for that. It's proven popular.
Yeah, and we are coming out with a hedging course in the next, I'm hoping about 6 weeks. Arnie, I did that. When do you use perps and when do you use dated futures? How do you decide which instruments to use and when? I only use dated, but I know Richard does both, depending on which side.
Yeah, I use perps exclusively until about the last week. If I've got positions that are in the money, I will hedge those with dated futures to match expiries. And that means I don't have to worry about partial hedging during the half an hour of expiry. And if you don't know what that means, it's because you haven't read the documentation on the Debit site about how the products work at expiry. And if you want an in-depth discussion on that, then by all means join us with a subscription, and I'll talk to you all day long.
Okay. So a question from Jalil. What do you think of a calendar, June 24, against the weekly? So I guess what you're saying is you're going to buy the June 24 and you sell the weekly. So more of a diagonal. I haven't looked at the June 24, but I did put on my diagonal was October because it's a shorter time frame. I didn't look at the vols, but in a historically low IV environment, it's probably a decent idea. You can kind of treat it like a covered call campaign, or a synthetic covered call. Are you looking at it right now?
I'm looking at the 10 delta. It's expensive because you're paying 65 vols, and then you're receiving 30 because of the steepness of the term structure in vols at the moment. Maybe on the puts, probably you could do it on the puts probably. Calls feels expensive at the minute. Maybe buy in the money call because then you're not paying the skew. And sell calls.
Or at the money. I guess you just have to play with those numbers, Jalil. But hey, I love those trades. If you're going to go long, now is sort of the time. With low IV. IV might continue to go lower. I don't know, but I think it's a good chance we're going to expand from here. Question from Luke. Lately, I experienced that it's not smooch. I think you meant smooth, I assume. What position you take, but how you get into that position. Yes, execution risk is important in low liquidity markets. Your opinion? Well, hey, I missed out. Didn't I, on some of my trades I showed you there because I was on the inside waiting to get filled and I didn't because I love to just be a maker. I love to be a maker all the time, but it's realistically sometimes you got to give up the ghost.
For me, because I trade a small amount every day, that trade you saw me put on today will be the only trade I do today, and I hedge regularly. And so, as far as I'm concerned, if I'll put an order in, and if it gets filled, it gets filled, and if it doesn't, it doesn't. And if it doesn't get filled, I'll just put it again tomorrow, or modify it at a different strike, or because I think in terms of vols, I want to sell a 15 vol call, then I'll sell whatever strike is 15 vol or close to it today, and if it doesn't get filled, I'll sell it tomorrow, and if it doesn't get filled, I'll sell 3 the next day. I don't really care.
Good point. Let me see here. We've got time for another question or two. Question from Sylvanus. There is an ETF decision to be made. You are right. Why are you not expecting volatility soon? Well, I'm just saying I'm not expecting it this summer, just because not much going on. Although I do see on the news, China is having some issues.
That's going to be the bigger issue. This ETF news has been going on for a long time. And look, there's a universal rule with news. Ignore it. It's bullshit. It's just people pay to have their articles stuck in the news, and they want you to believe shit because they want to move their positions around. And also, any real news you're getting way late, and all the market participants knew about it ages ago because they've all got Bloomberg terminals, and they all speak to each other in the same bars in Wall Street and the City of London.
Yeah.
So we ignore the news.
Yeah. Okay. Time for one last question, and we have to cut off. I'm sorry, we can't answer all the questions today, But of course, you can always catch us on our Rogue Trader Telegram channel. If you sign up for the free trial, get 7 days. We chat all day long on there. You can talk whatever you want. Last question here from Luke. This is a good one. And I guess it's in response to the trading you just did, Richard, and maybe what I was doing. Are you considering the vol when you enter those ratio spreads? Well,
yeah,
me,
you don't, do you? But I do.
No, not so much, because it is what it is. And those are short. Those are like 14, 15 days to expiry. So I was looking for rapid decay, a quick little thing, and that's it. But for you, vol is a little bit more important.
I'm not so much. I don't care so much about the absolute vol number of each position. I care about the relative vol between them, because actually, what I care about is the smile, the shape of the smile, and how steep it is, because that's what I trade. And there's actually another question from Ken, which is what is smile? And Ken, you should join a Rogue Traders course and learn all about it.
Yeah, smile is something that we look at, I'd say, every day. It's important. It gives you an idea what the market is thinking. So let's let it go there. I'm sorry, guys. We've actually run over time, and we are going to get spanked for doing that. But as always, great to have you. We're finally starting to see a little bit of movement in the market, which is wonderful. We're starting to see some of these trades we put on, directional trades, start to pay off a little bit. It was coming closer to the end of summer. It's going to be an interesting time. We're getting a little bit nervous about selling vol too far out in the future. Happy to do it short dated, easy to manage. So I'm really looking forward to next week to see what the market does between now and then. So until next week, we'll see you then.